Hello, I'm Annabel Brody-Smith, Communications Director of the Association of Investment Companies. As world leaders come together for COP27 in Egypt, there'll be discussions on climate change and the move towards net zero. Also, with the war in Ukraine continuing, there is ongoing concern over a global energy crisis. Now, renewable energy must be part of the solution to these problems, so it's very timely I'm talking to the Renewable Energy Infrastructure investment company managers today. We're going to be looking at the challenges and opportunities facing renewable energy infrastructure, but also what these investment companies can offer to investors. So today, I'm delighted to be joined by three managers: Jonathan Maxwell, manager at SDCL Energy Efficiency Income; Richard Lum, co-manager of VH Global Sustainable Energy Opportunities; and Michael C., co-manager of ThomasLloyd Energy Impact. Great. On to the questions. How are the current volatile market conditions affecting the renewable energy infrastructure sector? And I'm going to ask that question to Jonathan.
Thank you, Annabel. So, I mean, one thing to mention is that so much of the current volatile market conditions in general stem from gyrations in the energy market. So energy cost increases, availability problems, driving prices up, driving inflation up, interest rates reacting to that. So a lot of these matters are interconnected. There are therefore both headwinds, really significant headwinds, as well as very significant tailwinds behind the energy markets, and certainly behind renewable energy and what we do, energy efficiency. Just to focus on the headwinds to start with, increased volatility in markets has led to higher interest rate and inflation, rather, has led to higher interest rate environment. And I think that is affecting, Annabelle, live on the screen, the valuation of all investment companies linked to infrastructure within the context energy does not escape. However, a lot of the energy, given the fact that energy is a large part of inflation, and also that a lot of the contracts in the energy sector have some form of inflation linkage, a lot of the inflationary movements in the market also have a tailwind impact on the energy sector. More broadly, we're now dealing in an environment in which low cost, low carbon and reliable energy solutions have never been more valuable. When energy costs are high and energy security is a headline news and decarbonisation is increasingly challenging, then renewable energy and energy efficiency have a bigger role to play and is more cost effective than ever before. So I would say the outlook, notwithstanding short-term headwinds, medium-term headwinds, the medium to long-term outlook, and indeed the short-term impact that renewable energy and energy efficiency have, is enormously valuable. I think it's very timely to have this discussion.
Well, that's incredibly encouraging, Jonathan. Richard, what's your response? How are the current volatile conditions, affecting your company and the renewable energy sector?
Yeah, I'd like to and good day, Annabelle. Thanks for having me on. I'd like to make a differentiating point, I guess, at the outset, that in terms of the sector itself, I think you have to reflect, as Jonathan quite rightly articulated earlier, whether or not higher interest rates and higher inflation has a positive or a negative effect on your portfolio, given the level of leverage you may have, perhaps, or how exposed you are, to inflation, given that you're contracted in terms of your revenue streams. You don't have the ability to track that inflationary impact on energy prices. Now, we're fortunate enough that by design, within a GSCO, VH Global Sustainable Energy Opportunities PLC, the portfolio is very much being constructed on the basis that it's a friend of inflation. The revenue contracts very much track inflation. There are no caps. A lot of our investments are actually abroad in other local inflationary markets and benefit from that effect. And indeed, where we have exposure to energy prices, given that energy prices track inflation, we benefit from that effect as well. I think one of the other points, that has been articulated, the fact that, one of the key actually impacts in our sector. As an investor in sustainable energy infrastructure, has been the value chain, the supply chain issues that have arisen in terms of procuring the equipment, the cost of it, procuring the equipment, and the timelines that are required, etc., means you have to really contract your projects on a fully contracted basis, pushing off risks to your contractors, not bearing it as an investor or as an asset owner yourself. You have to think very hard about that. It may well have a more of a cost premium attached to it if you contract in that way, but you're protecting yourself in that environment as well. I think moving forward, the current phenomena we're seeing, in particular, in terms of the rise of energy costs, as it were, and the effect that has on the public consciousness, and in particular to governments around the world, it is focusing a lot more attention on the plurality of the supply of energy, including sustainable energy supplies as well. And that's a good thing. I think overall, it's not going to derail this movement towards energy transition in the longer term.
Thanks very much, Richard. I think it's a very good point you make about that inflation linkage, and big benefit of the investment company structure is the ability to invest in these sorts of assets. We see it here with renewable energy, we see it with infrastructure, we see it with certain types of property. Over to you, Michael. What's your take on this in terms of the current volatile conditions?
Yeah, I think we see many phases currently of that market environment. I think supply chain clearly, which was touched, is a very important point. And as we emerge from COVID, there's still a strain on supply chains, and that's not only of finished goods such as solar panels, but also for the raw materials which you use in the balance of plant in steel, concrete, glass, and many others. So as far as we are concerned, we have been protected from these issues over the past 12 months because we have no project in construction at the moment, therefore no project at risk in a sense of delay or price changes in the supply chain. And however, if we are bidding for new assets and for new capacities, in a sense, we as others would assume that you model these new assumptions, timings, and expected outcomes in your new bids and update for the reflect current knowledge. So I think that's one element on the supply chain. And on the other side, I think as we are at the moment quite significantly invested on solar power generation, when it comes to inflation, it's probably worth noting that solar plants operate on a very high EBITDA margin, so approximately 85 to 90% plus. Of the margin, therefore, is not linked to inflation. So the feedstock, which would normally be the highest component or a cost component in a sense of any operational power plant, has a fixed cost of zero. It's the sun, so it's not subject to inflation or political or any pricing disruption. So solar projects benefiting from, on our end, long-term fixed price contracts or offtake agreements, and are therefore stable in terms of project projections. However, in biomass, it's quite different. The second industry we've been in, like indeed any thermal plant where you have higher input costs, which are subject to inflation. Therefore, we operate them currently on a merchant tariff and would only be fixed if either we believe the risk to price level change is now on a long-term decline, or B, the contract offered, in a sense, would offer some inflation protection.